Let us say there are two companies, A and B. Some details are available, let's say, for the two companies. Let's say the market price per share for company A is 100 and the market price for company B, let's say, is 50 rupees. If you look at the number of shares, let us say company A has 10 lakh shares and company B is having, let's say, 5 lakh shares. So if we work out its market value, right, the market value over here, let's say, is 1000 lakhs, and the market value over here is turning out to be 250 lakhs, let's say. Now, A wants to take over B. A is interested in going for a merger. So A wants to take over B. Now, if you see, the market value of the company is 250 lakhs. So let's consider this 250 lakhs to be the fair value of company B. So if A wants to take over B, the first option that it has is that A pays in cash. Let us say A is sitting on cash of 250 lakhs. Let's say you are having huge cash reserves. So one possibility is that A can offer 250 lakhs in cash to company B and take over company B. Another possibility is, and this is something which is very popular, especially at the times of mergers and acquisition, is that A goes for a share offer. So A is making a share offer to company B. So instead of paying in cash, we will go for share exchange. Whoever is a shareholder of company B will surrender its shares in favor of company A. And that is how A will be able to buy the shares of company B. That is how A will be able to control B. Now, how exactly should I really decide what should be the share exchange ratio? Then some base has to be selected over here. Let us assume for a moment that we are selecting the base as the market price per share. Now, as you can see, the share price of A is 100 and the share price of company B is 50, right? So I can use the MPS as a base over here. As you can observe on the screen, the share price of company B is half of that of company A, isn't it? So we can consider that as the share exchange ratio. So we are suggesting a share exchange ratio of 0.5, or I can say the share exchange ratio is 1:2. 1:2, 1 by 2, 0.5, they all mean one and the same. 1:2 share exchange ratio means for every 2 shares which are there in the selling company, purchasing company will issue its 1 share. And that is how a share exchange will take place. Okay. Just see for a moment what will happen in that kind of a situation over here. Let me just remove a little bit of this. So we are saying we go for a share exchange ratio of 1:2, right? So the new shares that will be issued, right? New shares issued by A, the number of shares which are there in the selling company is 5 lakhs. I multiply that with the share exchange ratio. So the new shares issued will turn out to be 2.5 lakhs. Understand, these 2.5 lakh shares are of A Limited. And the value of 1 share of A Limited right now is 100, isn't it? So if I take 2.5 lakh shares and multiply that by 100, it is turning out to be 250 lakhs. This 250 lakhs is nothing but the value of the selling firm. So that's what I was saying even at the beginning. Value of company B is 250 lakhs. One way is you are having cash of 250 lakhs, you pay them cash 250 lakhs, right? And another way is we issue shares to the shareholders of the selling company. Understand right now, you are collectively the shareholders of selling company. Collectively, the value of your company is 250 lakhs. I am the purchasing company. I am offering shares to you in my company. So please understand, this 5 lakhs is shares of B Limited, while this 2.5 lakhs is shares of A Limited. Value of 1 share of A is 100. So the moment I am giving you 2.5 lakh shares of my company, am I not giving you something worth 250 lakhs? Isn't it? So either I pay you 250 lakhs in cash or I give you shares worth 250 lakhs. Ultimately, it is one and the same. You may, of course, wonder that how can it be the same? If I'm giving you cash, you can immediately spend that cash. Fine. I give you shares of my company. If you are not interested in holding the shares, see, my shares are listed on the stock exchange. You can sell the shares on the stock exchange and encash it. But anyone who is interested in the growth story, if A and B are merging, and if you are a shareholder of company B and you are of the view that after the merger the share price will rise, you can continue to hold the shares. So if you are in need of cash, you can sell the shares on the stock market. And if you are not in need of cash, you can continue to hold the shares, and the shares will keep on increasing on the stock market. And you can hold the share, and whenever you feel it is a good time, you can then sell the share. In a way, you are giving flexibility to the investor of B. You are giving flexibility to the shareholder of B. Whoever is in need of cash can sell the shares, and who are not, they can participate in the continued growth story of the company B, of course, as a part of company A. So, we are basically introducing a calculation known as share exchange ratio over here. As you can observe, over here, the share exchange ratio that we used was 1 by 2. So how is the share exchange ratio calculated? In our case, we base the share exchange ratio on market price per share. We argued that the share price of company B is 50, that of A is 100. Company B's share is trading at half the value of A. And that is the reason we suggested that the share exchange ratio be 0.5 or 1:2. So let us see mathematically how the share exchange ratio is determined. Okay, so let's discuss at a greater length that how shall we calculate the share exchange ratio. We can even call this as share swap ratio, right? They all mean one and the same. Share exchange ratio or share swap ratio. I'll continue with the same example that we had taken earlier. Company A and B. Our base is MPS. We said it is 150, right? The base can even be the earnings per share. Let us say the earnings per share over here is 2 and the earnings per share over here is turning out to be 4. The base can even be the P ratio. The base can even be the book value per share. There are lot many different bases that can be used. You may wonder in real life what base is used. To be very honest, in real life, there is no such thing as a definite base. When you are doing negotiations with the selling company, there are a lot many things that you are going to consider. So a little bit of NPS will be considered, a little bit of EPS will be considered, so is the P ratio, and a lot many other factors. So the final share exchange ratio will be decided on the basis of negotiations. But to keep things simple for this lecture, we will like to know that if I use the base as NPS, if I use the base as EPS, how will the share exchange ratios change? See, market price per share and earnings per share, these will be considered to be what is popularly known as positive base, right? I will call them as positive base. What do we mean by a positive base? Any base that is desired to be as high as possible will be considered to be a positive base. Ask yourself, will you like the market price per share of a company to be as high as possible or as low as possible? Let us say you have invested in shares of some company. Will you like the share price of that company to rise or will you like the share price of that company to fall? What will you prefer? Shall you prefer a higher MPS or a lower MPS? Obviously, I will like the MPS to be as high as possible. Okay. Will you like the earnings per share to be as high as possible or as low as possible? Will you be delighted if a company reports a loss? Then, okay, loss per share, EPS is reduced, really nice. Or will you like the EPS to be as high? Obviously, I will like MPS to be as high as possible, EPS to be as high as possible, PE ratio to be as high as possible, isn't it? That means all of these are what we call as positive base. As I said, positive base is a base that I will like to be as high as possible. Okay, so when you are selecting a positive base, the way you will calculate the share exchange ratio is, I'm writing in short, share exchange ratio is, you will take the selected positive base of selling company, okay, of selling company, and divide that by selected positive base of purchasing company. Okay, this is what we will do. So the base of the selling company will be divided by the base of the purchasing company. Why? Why are we doing this? See, we want this base to be as high as possible. If the base of selling company is higher, I do not mind giving them higher number of shares. If the base of the selling company is lower, when I say lower, higher compared to that of the purchasing company. Let us say I am the purchasing company, you are the selling company. Your ratio is stronger than mine. Understand? Your ratio is stronger than mine. Then as a purchasing company, I have no problem giving you more number of shares. Your ratio is inferior to mine. Then obviously I will like to give you fewer number of shares. You get my point? That is the reason the positive base of the selling company will be put in the numerator and the positive base of the purchasing company will be put in the denominator. See for yourself. See for yourself. If you see the market price per share, okay, we will take the base of selling company. Let's understand A as the purchasing company and B as the selling company. Okay, A wants to take over B. So as you can see, it is 50 divided by 100. I am the purchasing company. My share is trading at 100 rupees per share. You are the selling company. Your share is trading at 50 rupees per share, isn't it? Your company is trading at a lower market price. Obviously, I will give you less number of shares. When you will solve this, the share exchange ratio will turn out to be 1 by 2. That means for every 2 shares of your company, I will give only 1 share of my company. That's the reason we say the share exchange ratio is 1:2. I will give you fewer number of shares for a simple reason that your company's market price is lower than my company's price. Right? But let's turn the tables. Let's turn the table. Look at the earnings per share. Earnings per share. Your company earnings per share is 4 and my it is 2. So this is now turning out to be 2 by 1, or we can say 2:1. That means for every 1 share in your company, I will give you 2 shares. Your earnings per share is higher. My earnings per share is lower. If you are earning more profit per share, obviously as a purchasing company, I have no problem in giving you more number of shares. I hope you are getting my point, right? This is the reason the positive base of selling company will be in the numerator. If the positive base of the selling company is higher compared to the purchasing company will have to give more number of shares. And if the positive base of the selling company is lower than that of the purchasing company will give lesser number of shares. I believe it's very logical. Your book value per share is higher. I will give you more number of shares. Very obvious. Your company is trading at a higher market price. Naturally, I'm obliged to give you more number of shares. But if my company's share price is higher than yours, then why should I give you more number of shares? So that's how this will work. Now, having said this, at times the company may even consider some negative base. If there is a negative base, then this formula will change. Let's say you are doing something on the basis of a negative base. First of all, we try to understand what is a negative base. What was a positive base? Opposite of that will become the negative base. What's a positive base? Any base that I will like to be as high as possible is positive. And if there is any base that we will like to be as lower as possible, will be considered to be a negative base. Let's say, for example, we are considering long-term loans as a base over here. Try to think in that way. Let's say there are two companies, A and B. A has a long-term loan, I'm just putting in simplicity, of 2 lakhs. Okay. And B is having say loans of 10 lakhs. Right. And let us say we have decided that let us go for a share exchange ratio based on long-term loans. Now, ask yourself, will you like debt of a company to be as high as possible or as low as possible? When I ask the question, I just find the question itself to be very ridiculous, but still I'm putting it before you. Will you like a company which has huge amount of debt? For example, A wants to take over B and you are studying the balance sheets of B, and in the balance sheet of B, you are seeing a loan of 10 lakhs and you are in the management of company and you are like, wow, such a huge amount of loan. That is so nice. Let me take over this company. Will you really feel like that? Or you are worried and concerned about the high amount of debt which is there in the company that you are planning to buy? Tell me, are the long-term loans of B exciting you as a purchasing company? Or you are concerned, you are apprehensive that should I take over a company which has so much of debt? I believe you will be concerned, isn't it? So this is turning out to be a negative base. I will like the negative base to be as low as possible. So this time there will be a slight change in the formula for the share exchange ratio. Okay, earlier there was a positive base. Now I'll say selected negative base of purchasing company. Okay, earlier we were putting in the numerator selling company. Now I'll put the purchasing company. And this I will divide by selected negative base of selling company. Okay, in our example, tell me what will happen in our example. It will become, yes, the negative base of purchasing company, that is 2. So it will be 2 divided by 10. So it will turn out to be, let us say, 0.2. 0.2 is to 1. What does that mean? Or I can even write this as 1 by 5. I can even say this 1 is to 5. For every 5 shares in the selling company, I will issue only 1 share of my company. Simple. I am planning to buy your company, but your company has too much amount of debt. If your company has too much amount of debt, I am not going to give you a lot of money. Because once I take over your company, I have to take care of your loans. I have to take care of your creditors. I have to take care of your liabilities. So as a purchasing company, I'll pay you less, right? I'm going to pay you less because I have to set aside a lot of money for the liabilities that you have. For example, one more example of a negative base. Let us say NPA, non-performing assets. Let us say there is one bank which is planning to take over another bank. Okay, let's take a case of bank A and bank B. Let's say A wants to take over bank B, and B is having huge non-performing assets. What do you say? You are so happy, isn't it, that we will take over a bank which has huge amount of non-performing assets. Is it so? Or you are really worried? You are really thinking 2 to 3 times that should we really take over this bank which has so much of non-performing assets, isn't it? Perhaps you will be evaluating this decision so many times. Maybe bank B is really good, but it has too much of non-performing assets. Should I really take over a bank which has such a large number of NPAs? So by chance, if you are deciding that let us make NPA as one of the selected base for share exchange ratio, I will like my NPS to be as low as possible. That means it is a negative base. So NPS of bank A will be divided by NPS of bank B. That is, selected negative base of purchasing company will be divided by selective base of the selling bank or the selling company. And thereby we will work out the share exchange ratio. If I am taking over your bank and your bank has too much of non-performing assets, I will pay you less. Okay, I will pay you less. Why should I pay you more? Because you have just huge amount of NPS. I shall be penalizing you for the higher amount of debt that you are having. I will penalize you as a selling company for the higher amount of non-performing assets that you are having. As a purchasing company, I want to take over a company. I want to take over a bank which is fundamentally strong. High amount of debt, high amount of non-performing asset is a sign that you are having higher liabilities. If you have higher liabilities, I will pay you less because I also need sufficient money for the liabilities of your company, which I am going to take over. So that's how we calculate a share exchange ratio. First, decide what should be the base for calculation. Then decide whether it's a positive base or a negative base. If it is a positive base, then take the base of the selling and divide by the base of purchasing. If the base is negative, then take the base of purchasing and divide that by the base of selling. The most fundamental thing, how will I decide whether the base is positive or negative? Okay, look at the base and ask yourself, will you like this base to be as high as possible? If your answer is yes, it is positive. If your answer is no, then it is negative.